we are covering the essential topic of cost sharing for your health insurance licensing exam. This includes deductibles, copayments, and coinsurance, and how they determine the final out-of-pocket cost for the insured. On the exam, you will absolutely be tested on your ability to calculate how these three components work together. First, let's break down deductibles. A deductible is the amount the insured must pay out of pocket before the insurance company starts paying for most services. The exam will test you on two main types of deductibles. A calendar year deductible resets on January 1st of each year, regardless of when the policy started. In contrast, a per-cause or per-service deductible applies to each new illness or injury. For example, if an insured has a per-cause deductible and is treated for a broken arm and later for the flu, they would have to satisfy a separate deductible for each condition. You'll also see questions on individual versus family deductibles. An individual deductible applies to each person on a policy, while a family deductible is a total amount that can be met by the combined expenses of all family members. A common exam trap involves embedded deductibles. With an embedded deductible, once an individual family member meets their individual deductible, their coinsurance will kick in for their own expenses, even if the larger family deductible has not yet been met. Next are copayments, often called copays. A copayment is a fixed dollar amount the insured pays for a specific service, like a doctor's visit or a prescription. For example, a plan might require a $30 copay for a primary care visit. Importantly, copays are typically paid at the time of service and often do not count towards the deductible. The exam might try to trick you by including the copay in deductible calculations, so be careful to separate them. Finally, there is coinsurance. Coinsurance is the percentage of the cost of a covered service that the insured pays after they have met their deductible. A common coinsurance split is 80-20, where the insurance company pays 80% of the covered expenses and the insured pays the remaining 20%. Let's walk through a typical exam-style scenario. Imagine an insured has a $1,000 calendar year deductible, a $50 copay for office visits, and an 80-20 coinsurance provision. They have a surgical procedure that costs $11,000. First, the insured pays their $1,000 deductible, leaving a balance of $10,000. Next, we apply the coinsurance. The insured is responsible for 20% of the remaining $10,000, which is $2,000. The insurance company pays the other 80%, or $8,000. So the insured's total out-of-pocket cost for this procedure is their $1,000 deductible, plus their $2,000 coinsurance portion, for a total of $3,000. The copay was not a factor here because it applies to office visits, not major procedures. A great way to remember the order of payment is the mnemonic DCC, which stands for deductible, then coinsurance, then copayments. While copayments are often paid first at the time of service, for major medical expenses, you must satisfy the deductible before the coinsurance split applies. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.